Next problem, problem 19. Durga Prasad, resident, gives you the following information. Compute his income under the head capital gains for the assessment year 1920. First one, agriculture land, Chennai city, purchased on 8-9 financial year for rupees 2,25,000. CI value on financial year 8 and 9 is 137 rupees, has been sold for rupees 10 lakh 50,000 on 1/8 2018. CII rupees 280 for the financial year or previous year 18 and 19, but paying rupees 25,000 as brokerage. So this is the realization or transfer expenses. We purchased another agriculture land in a village for rupees 2,50,000 on 10/6/2018. So we can claim the exemption under section 54B because he is selling the asset called as agriculture land which has been situated in the urban area, and after selling that he is going to purchase the new agriculture land in the year that is 10/6/2018. So we can claim the exemption under section 54B. So first take the asset number 1. Agricultural land. Next, period of holding, so that is date of purchase and end on date of sale. So the asset has been purchased on the financial year 8 and 9, and it has been sold on the date called as 1/8/2018. The purchase date 8 and 9 to 1/8/2018. So now identify whether it's a long-term capital asset or short-term capital asset. So agriculture land is fall under the fourth category. So if it is used for more than 2 years, long-term capital asset. Used for less than 2 years, it's a short-term capital asset. So since the asset has been used for more than 2 years, so the asset will be called as long-term capital asset. Now calculate the income from capital gain. So first take the value called as gross sale consideration. So the asset has been sold for rupees 10,50,000. So that will be the gross sale consideration. 10,50,000. From that minus the realization expenses, and in the problem they told that the assessee is going to pay the rupees 25,000 as brokerage expenses. If you check, the assessee is paying rupees 25,000 as brokerage expenses, so that will be the realization expenses. So take realization expenses as 25,000. So the balance amount will be 10,25,000 is the net sale consideration. Now from the net sale consideration, calculate the index cost of acquisition because it's a long-term capital asset. So the formula, cost of acquisition divided by CII of purchase year into CII of transfer year. So the cost of acquisition is, since the asset has been purchased before 1/4/2001, sorry, after 1/4/2001, so the purchase price will be the cost of acquisition. So the asset has been purchased for the value of rupees 2,25,000 and the CI value is 137. So take the value, cost of acquisition is 2,25,000 divided by 135. For 137 is the CII of purchase year, that is 8 and 9 financial year, into sale, that is previous year, to 80 rupees. Now calculate the index cost of acquisition and we get the value 4,59,854. Next, since they are not given any information of additions, the index cost of improvement will be nil. Now, the balance amount is 5,65,146 is the gross capital gain. If you observe the problem, the assessee is purchasing the new agricultural land. So check the date. He has been purchased the new agricultural land in a village. So even though it's an urban area or the rural area, if he is purchasing the new additional land, he can claim the exemption under section 54B. So the condition: before 1 year from the date of transfer, after 2 years from the date of transfer. Okay, so since he can claim the exemption, the exemption amount under section 54B. So purchase of new agricultural land. So exemption amount will be gross capital gain, gross capital gain, or cost of agricultural land plus amount deposited in the capital gain account scheme. So first take the value. Gross capital gain is 5,65,146, or cost of new agriculture land is rupees 2,50,000, and they have not given the information about the capital gain account scheme. It will be taken as nil. So whichever is lesser value, so the lesser amount is 2,50,000 is the exemption amount. So take the exemption under section 54B is 2,50,000. So the balance amount will be that is 3,15,146 is the taxable long-term capital gain. Next, second asset, household furniture and music system purchased on 1/1/2011 for rupees 22,000 is sold on 3/12/2018 for rupees 12,000. But if you observe, the asset is household furniture and music system. So these are the movable asset which has been used by the assessee for his personal use. So household furniture is nothing but it has been used for his personal purpose. So such asset will not be a capital asset as per the section 2 of 14. So we are not going to calculate any income from the capital gain for that asset. So just we are going to take asset 2 as household furniture and music system is not a capital asset as per section 2 of 14 because it has been used by the assessee for its personal purpose. So next we'll go with the third asset. So third asset is machinery purchased on 1/1/2009 for rupees 40,000. So the machinery always it will be a depreciable asset, and any depreciable asset will always be treated as short-term capital asset. So the cost of acquisition or the purchase price is 40,000. CA value 137 rupees is sold for rupees 50,000 on 1/4/2018. That is in the previous year. So the return on value of machinery on 1/4/2008 was rupees 25,000. So instead of cost of acquisition, we need to take the written down value of the machinery at the beginning of the previous year, because the machinery is a depreciable asset. So take the asset as machinery and the period of holding all the asset, or since it is a depreciable asset, it will be treated as short term, or always it will be treated as short term capital asset. Now calculate the income from capital gain. So first, the gross sale value, that is 50,000, is the gross sale consideration. So take the value, sale consideration is rupees 50,000. 50,000, and no information about the transfer or the realization expenses, so it will be taken as nil. Next, from that, minus T, net sale consideration. So net sale consideration is 50,000. Next, cost of acquisition. So this cost of acquisition will be replaced by written down value as on 1/4/2018, because the asset is a depreciable asset. So the written down value as on 1/4/2018 is rupees 25,000. So take the 25,000 as an written down value. 25,000, and no improvement. So improvement will be taken as nil. So the balance amount will be 25,000, and from that, claim any exemption. No information. The exemption will be nil, and the balance amount will be 25,000. So it will be a taxable short-term income. Next, take the fourth asset. So the fourth asset is sold is a residential house for rupees 40 lakhs on 1/3/2019, that is previous year. The house was gifted by his mother-in-law in July 1980. So here he is getting the house property in the form of gift from his mother-in-law in the year 1980. The house was purchased by her in the year 1979 for rupees 3,25,000. FMV on 1/4/2001 was rupees 3 lakh. Additions were made by him in June 2003 by spending rupees 30,000. So CI value is 109. He purchases another residential house for rupees 2,25,000 and deposited rupees 75,000 under capital gain account scheme on 30th 6 2018. So if you observe in this asset or in this situation, the assessee is getting the capital asset in the form of gift. So whenever any assessee is receiving the asset in the form of gift, please understand the condition. If any asset which has been received in the form of gift or in the form of will, we need to calculate the period of holding from the date of purchase of the previous owner and the date of sale. So the period of holding will be date of purchase of the previous owner, and it will be end on date of sale by the assessee. And the assessee will be the person who is going to sell the asset. So the date of purchase will be, so first take the asset. Asset is residential house property. Now calculate the period of holding. So the asset has been purchased by the previous owner on the date 1979 and it has been sold on the date called as 31st March 2019. If you check the date, so the asset has been sold on the date called as 31st March 2019. Now calculate the type of capital asset. So house property is an immovable property. It falls under the fourth category. So conditions, if it is used for more than 2 years, it's a long-term capital asset. If it is used for less than 2 years, it's a short-term capital asset. So it is used for more than 2 years, hence the asset is long-term capital asset. Now calculate the gross sale or the capital gain. So first take the value called as gross sale consideration. So the gross sale consideration is rupees 40 lakhs. 40 lakhs. Now from that, from that claim any realization expenses or transfer expenses. So there are no information or there is no information reality regarding the realization expenses. It will be taken as nil. So the balance amount will be 40 lakhs as a net sale consideration. Now, since it is a long-term capital asset, we need to calculate the index cost of acquisition. So the formula same, cost of acquisition divided by CII of purchase year into CII of transfer year. So since the asset has been purchased before 1/4/2001, so cost of acquisition will be purchase price or FMV as on 1/4/2001, whichever is highest. So check the purchase price of the asset. So the asset has been purchased by the previous owner for the rupees 3,25,000 and the fair market value as on 1/4/2001 is 3 lakh rupees. So take the value 3,25,000 or 3 lakh, whichever is highest will be the cost of acquisition. So the highest value is 3,25,000 divided by cost of CII of purchase year. So before 1/4/2001, always it will be taken as 100 into previous year CI value is 280 rupees. So calculate the value, that is 9,10,000. That is the index cost of acquisition. Next, calculate the index cost of improvement if any additions has been done by the assessee or the previous owner after 1/4/2001. So check the problem. So the assessee has made additions on June 2003. So it is after 1/4/2001. So it is eligible to claim or to calculate the index cost of acquisition of the value of rupees 30,000 and CA value is 109. So take the value cost of improvement is cost of improvement 30,000 divided by 109 into 280. Index cost of improvement will be 77,000 0.064. Now minus the amount from the net sale consideration, so we'll get the balance amount, that is gross capital gain. Balance amount will be 30 lakh 12,936. Now check the problem whether the assessee can claim any exemption. So if you check the problem, the assessee has sold the asset in the previous year, and within the 1 year from the date of transfer, prior to the date of transfer, he is going to purchase the asset. Correct? Now take the amount for rupees 75,000. He has been deposited in a capital gain account scheme, and he has purchased a new residential house property for rupees 2,25,000. So he can claim the exemption under section 54. So exemption under section 54. So exemption under section 54 states that the assessee has to sell the long-term residential house property, and he needs to purchase the new residential house property within 1 year prior to the date of transfer, within 2 years from the date of transfer, and he need to construct the house property within a period of 3 years from the date of transfer. So if he satisfy the conditions, he can claim the exemption under section 54. So the exemption amount will be gross capital gain or cost of new asset plus amount deposited in a capital gain account scheme. So the gross capital gain is 30 lakh 12,936, or cost of new asset is 2,25,000 plus amount deposited in a capital gain account scheme is rupees 75,000. So if we check, the lowest value is 30 lakh 12,936 or 2,25,000 plus 75,000. So the value is 3 lakh rupees. So we need to take both the value. So the exemption or the lowest amount is rupees 3 lakh. That is the total of cost of new asset plus amount deposited in a capital gain, whichever is lesser. So the lesser amount is 30 lakh. So we can claim the exemption of rupees 3 lakh. So the balance amount will be 27 lakh 12,936. And last asset we have, that is debentures purchased in December 2013 for rupees 30,000 or sold for rupees 55,000 on 1/9/2018, that is in the previous year. So first take the asset, debentures, So the purchase date is 1st December 2013 and the sale date is 1/9/2018. Now debentures will fall under the first category, that is financial asset. So the condition, if it is used for more than 1 year, the long-term capital asset. If it is used for less than 1 year, it's a short-term capital asset. So the debentures has been used for more than 1 year, it will be called as long-term capital asset. We'll calculate the income from capital gain. So first take the value called as sale consideration. So the asset has been sold for rupees 55,000 and no information regarding the realization expenses. So the realization expenses is nil. And the net sale consideration will be 55,000. And since the asset is a debentures, and even though it's a long-term capital asset, the index cost of acquisition will not be applicable for debentures. I'm repeating, even the asset is a debentures, and if it is a long-term capital asset, the index cost of acquisition will not be applicable for debentures. Only we need to take the cost of acquisition. So first take the cost of acquisition. So cost of acquisition is rupees 30,000, and cost of improvement, there is no any additions, so improvement will be nil. So the balance amount will be 25,000. So no exemption information, so nil. So the balance amount will be 25,000. So after that, if you calculate the total income from all the assets, if it is necessary.